Hello everyone and welcome back to lecture series on Economic Survey 2022-23. This is lecture number 9. Today we are going to do a very important topic from Economic Survey, which is chapter number 4, Monetary Management and Financial Intermediation, a good year. Economic Survey says that 2022-23 was a good year from the perspective of monetary policy and capital market. It does not mean that everything was nice and stable in banking, in finance. It simply means that compared to 2020 and 2021, 2022 showed good and positive performance. Let us look at the structure of this topic. We are dividing this topic into 3 different parts. In the first part, we are going to study monetary policy. Under monetary policy, we would start with absolute basics. So for example, the meaning and definition of repo rate, reverse repo rate, standing deposit facility. It's a new instrument by Reserve Bank of India. Then marginal standing facility, CRR, and then something called as liquidity corridor. We would also look at some additional points. For example, what is the meaning of basis points? Then we would look at the meaning and some recent development related to monetary policy transmission. Then we would study something related to monetary aggregates and money multiplier. And then we would understand the recent developments related to government securities and bond yield. So guys, since bond yield is connected to repo rate, so I'm going to cover the bond yield developments under monetary policy only. Once we complete the monetary policy, then we would look at the developments in the banking sector in part 2. Here we would look at scheduled commercial banks, then NBFCs. We would also look at some concepts related to non-performing assets and insolvency and bankruptcy code. And then we would look at some recent developments in the banking sector. Even though the current economic survey has not given detailed analysis of banking sector in India, they have just given the basics. So we will stick to the basics. Then we would come to capital market. In the capital market, we would look at primary and secondary market. And here we will look at both equity shares and bonds. Then we will look at something called as stock market index and India VIX. India VIX is also called as fear index. Then we would look at IFSC Gift City, International Financial Services Center, Gift City, which is in Gandhinagar, Gujarat. Then we would look at the developments related to insurance sector and pension sector. According to experts, the best policy to follow during an economic crisis is a combination of fiscal and monetary policy. So guys, let me take you back to the COVID crisis phase. See, when COVID crisis happened, what is the first thing that the government of India wanted to do? The government of India wanted to provide food, medicine, and money to the citizens so that they can fulfill the basic requirements of day-to-day life. But COVID also impacted the business community. So the government of India knew that if we want economic revival, we have to provide purchasing power to the people so that they can demand more goods and services and fulfill their requirements. And we also have to provide credit to the business community so that they can increase the production of goods and services which can fulfill the demand of the society. How did the government of India do that? Through a combination of fiscal as well as monetary policy. Let us see what the government did. During COVID crisis, the government of India followed expansionary fiscal policy. For example, the government of India was constructing more roads, more hospitals. So whenever the government of India invests more money in the field of infrastructure, it leads to more job creation. When people get little more job, it will also increase the income of those people who are getting employment. When income increases, the people will demand more goods and services, and it leads to increase in aggregate demand in the society. This is called as expansionary fiscal policy. Along with expansionary fiscal policy, the government of India also followed a policy called as expansionary monetary policy. It is also called as liquidity easing. What happened under that? Between the month of March and May 2020, this was the time when COVID started. The government of India started to reduce the repo rate. So for the time being, let us assume that repo rate is the normal rate of interest in the economy. So repo rate was roughly around 5%, but from 5% it started to come down between March and May to around 4%. Now between May 2020 and April 2022, the Reserve Bank of India maintained the repo rate at 4%. So guys, when you keep the repo rate low or rate of interest low in the economy, what are the two things that happen? Number one, the business community will take more loan and they will make investment in the business. So goods and services will start to increase. And Government of India particularly provided more credit to the MSME sector. So in the economy, the aggregate supply of goods and services will increase. Also, when the loans become cheaper, when the rate of interest is low, people will take more loans so that they can demand more houses, more cars, more computers, more washing machine and fridge, right? So basically consumer goods type of loan is also demanded by the society. So when interest rate is low, aggregate demand increases even more and aggregate supply also increases. But we know that the increase in aggregate demand is very fast, whereas the increase in the production of goods and services, which means increase in aggregate supply, takes time. So we can clearly see here that increase in aggregate demand is greater than increase in aggregate supply. Now, whenever demand increases faster, supply increases little slowly, demand is more than supply, it leads to inflation. So inflation happened in the economy because there was too much of cash in the economy, too much of liquidity. To control that, the Reserve Bank of India between May 2022 and December 2022, they increased the repo rate. Reserve Bank of India also started a system called as Standing Deposit Facility, SDF. This was also being used to reduce liquidity or cash in the economy. We can see that between April and December, see how Reserve Bank of India increased the repo rate slowly. So 4%, then 4.4, 4.9, 5.4, 5.9 and 6.25. So when interest rate increases, the business community will take less loans. People will also take less loan. So what will happen? Because of less loan being taken, aggregate supply comes down and also aggregate demand comes little down. So we can see that when Reserve Bank of India started to follow contractionary monetary policy. What is contractionary monetary policy? When we increase the rate. So when they started to follow contractionary monetary policy, we can clearly see that the increase in aggregate demand came little down. So here you can see how many arrows are there? 4. So demand was very high. Here demand has come little down. Here we can see supply was also increasing, but here supply is increasing but at a slower pace. And why has this happened? Because rates have increased. In this context, let us look at the developments in the field of banking, monetary policy and capital market through this chapter in economic survey. So guys, now let us look at some of the basic concepts related to monetary policy. The first concept that we will understand is repo rate. Now guys, imagine that HDFC Bank requires little more funds. So for example, there are too many people who have come to HDFC Bank to ask for home loans, and HDFC Bank at that point does not have cash. So HDFC Bank can approach Reserve Bank of India and ask for this loan. So when Reserve Bank of India gives a loan to HDFC Bank, in return HDFC Bank would have to provide some collateral or security. So what is the collateral that HDFC gives to Reserve Bank of India? The government securities or government bonds. And you very well know that whenever you take a loan from somebody, you have to pay interest, because in future this loan has to be returned, but interest rate also has to be paid. So Reserve Bank of India charges an interest rate from HDFC Bank. The name of that interest rate is called as repo rate. So for example, let's say that whenever Reserve Bank of India gives cash to HDFC, the repo rate of 6.25% is charged. But guys, sometimes it might happen that we become little indisciplined in life. At that time, what do our parents do? The parents give us a nice dose of lecture, and the parents tell us that one should keep emotions in control, one should not overspend. If your pocket money is 1,000 rupees, we should save something, not spend the entire pocket money, isn't it? Similarly, Reserve Bank of India is that kind of guardian who also tries to discipline the banks. So for example, suppose that under repo rate system, HDFC Bank, for example, has taken 10 crore rupees loan from Reserve Bank of India. But suppose that HDFC Bank requires more fund beyond 10 crore for one night. HDFC has committed to give more loans to people, etc. And some urgent requirement has come. For that, SDFC requires little extra cash just for one night. Now, when SDFC will come to Reserve Bank of India, RBI will say that you have already taken money under repo rate. Why did you become indisciplined that you require more funds? So in that case, Reserve Bank of India might give little extra loan to HDFC, but this time Reserve Bank of India will not charge repo rate. Reserve Bank of India will charge an interest rate which is higher than repo rate. That interest rate is called as marginal standing facility rate. So for example, it could be 6.5%. This rate is like a punishment rate. That is why this rate is also called as penal rate. Why? Because the very fact that HDFC has to come to RBI to take loan after repo, that means SDFC might have become indisciplined. That is why Reserve Bank of India charges a punishment rate which is slightly higher than repo rate. So this is called MSF. So what did we learn? That MSF is greater than repo. Now let us look at two more concepts. First is called as reverse repo and second is called as standing deposit facility. So let us first look at reverse repo. So guys, does it happen many a times that we as society deposit a lot of cash with our banks? Yes, it happens. So what are the two types of deposits that we do with the banks? So for example, we open savings account when we put our money in the bank. Similarly, we do fixed deposit also. Fixed deposits are called as time deposits. Because if we deposit something in the nature of fixed deposit for 1 year, we can take it out only after 1 year. So that is called time deposit. And when we open savings account with a bank and put our money, that is called demand deposit. So suppose in the economy, people have done a lot of demand deposit and time deposit with SDFC. So SDFC has extra cash. Now HDFC wants to give that extra cash to RBI. So whenever you give your cash to RBI, RBI will give you government securities or bonds, right? And since HDFC Bank is giving cash to RBI, Reserve Bank of India will offer some interest rate to SDFC. That interest rate is called as fixed reverse repo rate. It is popularly also called as repo rate, right? But what is the noteworthy point here? That whenever banks give their cash to RBI, RBI gives government securities to banks and RBI pays interest rate to the bank. But there could be a problem because of this. The problem could be that if RBI starts to give government bonds or securities to HDFC, etc., then most of the bonds of RBI will go in HDFC Bank. And in future, if RBI wants to sell bonds in the market, maybe RBI wants to sell bonds in the market, because if RBI sells bonds, RBI will get more cash. So in future, suppose RBI needs cash and RBI wants to sell bonds, but bonds are not available. So how will RBI sell bonds? So if RBI accepts too much cash from our banking system, all the bonds of RBI will go to the bank. To remove this problem from the banking system, Reserve Bank of India developed something called as a standing deposit facility. What is a standing deposit facility? So under standing deposit facility, if a bank like HDFC wants to deposit their cash with RBI, see, cash is coming to RBI, RBI will not give any government bond to SDFC. RBI will only provide a rate of interest, for example, like 6%. This is an example. So RBI will provide 6% rate of interest to SDFC. This rate of interest is called standing deposit facility. In earlier case, what was the rate of interest called as? Fixed reverse repo rate. Now it is called as standing deposit facility. What is the difference here? RBI gives bonds or government securities to SDFC, etc. Here RBI does not do that, which means the bonds of RBI is free. And that bond is still available with RBI. In future, if RBI would like to sell those bonds to somebody to raise cash, RBI can do that. So that is the reason that we developed this system of standing deposit facility. So now guys, let us look at another concept of banking called as cash reserve ratio, CRR. Now imagine that there is a bank, HDFC. There is a depositor. This depositor has deposited 100 rupees in HDFC Bank. The moment SDFC gets this 100 rupees, SDFC gives this 100 rupees, the same 100 rupees as loan to somebody who wants to buy a house. So 100 rupees gone. Now, After a few days, this depositor comes to SDFC and says, please return my cash. Will SDFC be in a position to return the cash? No. Similarly, suppose this depositor has deposited 100 rupees, SDFC gives 100 rupees to a borrower. This borrower has taken money to buy a house. But suppose this borrower defaults on the loan and the borrower says, sorry, my money is gone, I cannot return the money, I have become bankrupt. Which means this borrower can never return 100 rupees to this bank called SDFC. So if the depositor comes to SDFC in future and says, please give me my cash back, SDFC cannot return the cash. This can also lead to problem. Now, to avoid this kind of problem, Reserve Bank of India has started a system of CRR. What is CRR? So, in a very simple language, in a very simple setup, suppose that a depositor gives 100 rupees to the bank. Immediately, Reserve Bank of India says that out of your 100 rupees that you are getting, in a very simple language, layman language, out of 100 rupees that you have got from depositors, take out 5 rupees and give it to RBI in a piggy bank. So what is a piggy bank? As kids, we used to have those piggy banks. So Reserve Bank of India tells this bank that whenever depositors give you cash, take out a certain percentage like 4%, 4.5%, 5% and deposit it with RBI. This money will remain with RBI. This money, rupees 5 or 5% or 4.5% is called CRR. So CRR is like that money which is there in the piggy bank of RBI. Now, whenever CRR is increased, that means the loan giving capacity of HDFC Bank will come down. Now let us look at the concept called as basis points. Guys, you remember when we were in school and colleges, when we used to appear in the exams, we used to get percentage of marks. Like total marks in a subject was 100, we used to get 90, that used to be called as 90%. Somebody got 91%, etc. So measuring marks through percentage was very easy. But suppose I ask you a question that can you please tell me that what is the total amount of dust particle present in the atmosphere which is leading to pollution? So are the dust particles very heavy? Can we measure their change through normal units of measurement like percentage? Very, very difficult. So we need a new measurement of dust particles, etc., which lead to pollution in the atmosphere called as parts per million, ppm. Similarly, if we have to measure big changes in the economy, we use percentage. But if we have to measure very small changes in the economy, we use a concept called as basis points. Now, for example, what is a basis point? So let us see. So let us draw a number line from 0 to 100. So let's say that this is 0%, 1%, 2, 3, 4, 100%. Now, let us say that repo rate increases from 6% to 7%. So for example, if this is 6%, repo rate has become 7%, very easy to see. But suppose the Reserve Bank of India has increased the repo rate in a very, very small amount, through a very small amount. How do you measure that amount? So for that, what we do is between 0 to 1%, we will divide it into 100 equal parts. So we take 1% and divide it in 100 equal parts. Each part, which means 1/100th of a part, is called as 1 basis point, which means between 0 to 1 it is 1%. 1% has been divided into 100 parts. So 1% is equal to 100 basis points. So using this concept, let us try to understand something called as liquidity corridor. So guys, we saw some time back that if we take scheduled commercial banks, for example, HDFC Bank or State Bank of India, if they require loan from RBI, they have to pay a rate of interest called as repo rate. But if suppose banks require funds for emergency purposes for overnight, maybe because they became little indisciplined, then Reserve Bank of India charges marginal standing facility from them. So MSF is higher than repo rate. But imagine that we are HDFC Bank or SBI, and suppose you are Reserve Bank of India. If I give my cash to you, Reserve Bank of India will give me reverse repo rate, right? So reverse repo rate is called as floor rate because out of these three, reverse repo rate is the minimum. and marginal standing facility is the penal rate, punishment rate, so it is called upper bound, and repo rate was lying in between MSF and reverse repo. So around the time when COVID started, and in the initial phases of the COVID in the year 2020, the Reserve Bank of India reduced repo rate, marginal standing facility and reverse repo. All the three rates were reduced. This is called as expansionary monetary policy, because when you reduce the rate, availability of cash in the economy will increase. Now, after May 2020, the Reserve Bank of India kept all the rates at the same level at which they had fixed them until the month of April, which means repo rate was kept at this level, see, fixed, marginal standing facility fixed, reverse repo fixed. So between May 2020 till April 2022, all the rates were fixed at their levels. But in the month of April 2022, Reserve Bank of India realized that they must take some action to control inflation because there was too much cash in the economy. What do we do to control inflation? We increase the repo rate. So Reserve Bank of India started to increase the repo rate. Right? When RBI increased the repo rate, RBI also increased marginal standing facility. But something new was done after that. Instead of increasing reverse repo rate, Reserve Bank of India introduced a new concept called as a standing deposit facility, SDF. Now, Reserve Bank of India started to use SDF instead of reverse repo rate from April 2022 onwards. So what did we do? We increased repo, we increased MSF, and we started to increase SDF, standing deposit facility. So for example, if you look at the repo rate is 6.25% in the economic survey. They have taken the figure till the month of December. So repo rate 6.25%, marginal standing facility 6.5%, and standing deposit facility 6%. So if we look carefully at these three, we will see that the distance between MSF and repo and the distance between repo and SDFC, the distance is same. And what is the distance between MSF and repo? 25 basis points. See, 6.25, 6.5. And what is the distance between SDF and repo? Again, 6 and 6.25, 25 basis point. So if somebody asks us a question that distance between these two 25 basis point, distance between these two 25 basis point, and what is the distance between MSF and SDF? 50 basis points. Between these two, 50 basis points. So what have we done in India? After April 2022, we started to use standing deposit facility as the floor rate instead of reverse repo rate. So guys, till April 2022, MSF and reverse repo rate, this corridor, this gap used to be called as liquidity corridor. But after April 2022, the gap between MSF and standing deposit facility, this gap is called as liquidity corridor. And one of the important points that we must note from liquidity corridor of India is that repo rate is used as a signal rate by RBI in India. I'll give you an example. So for example, let's say that you are going to a bank to take a loan to buy laptop. Now, if you take a loan of 1 lakh rupees, bank will charge you, let's say, 7% rate of interest. Now, suppose the Reserve Bank of India makes an announcement that from today, the repo rate of India is coming down. So since repo rate is the signal rate, it is like a signal to the bank that banks should also reduce their lending rate. So now when you take 1 lakh rupees loan to buy a laptop, you should not pay 7%, you should pay less than that. For example, let's say 6%. This is called as monetary policy transmission. So monetary policy transmission is the mechanism through which whenever there is a change in policy rate in India like repo rate, the benefit of that change in the policy rate must reach the consumer. So if RBI is reducing the repo rate, it must reach the consumer. And if RBI is increasing the repo rate, then overall interest rate in the economy, including lending rate, should also increase. So if this happens efficiently in the economy, then we say that monetary policy transmission is efficient. But we might have noticed that in the past, whenever we used to go to the banks to take home loan, for example, you can talk to your parents and they will tell you that earlier they used to do homework. So if you go to SBI to take home loan, SBI will charge you 8% rate of interest. SDFC will charge you 7.5. Another bank will charge you 6% rate of interest. There used to be huge variation in the rate of interest when you take home loans in the economy, which means the banks were not following a standard method of calculation of lending rate. So Reserve Bank of India from the year 2019 changed the method, and RBI said that whenever banks are deciding lending rate, so if you go to a bank to take loan, the rate of interest that the bank charges is called lending rate. So from the year 2019, RBI said that whenever banks are deciding the lending rate has to be connected to one of the 4 rates prescribed by RBI. So if HDFC Bank is giving home loan, the rate of interest charged by HDFC Bank must be connected to either the repo rate of India or the rate of interest mentioned on 91-day treasury bill. So 91-day treasury bill is like a government bond whose maturity period is 91 days. Or the lending rate should be connected to 182 days treasury bill rates, or it should be connected to any rate which is prescribed by Financial Benchmark India Private Limited. So either of these 4. So if I am State Bank of India and if I am giving home loan, the rate of interest that I have to charge must be connected to either of these 4. So that, for example, if I am State Bank of India and my lending rate is connected to repo rate, so whenever RBI reduces the repo rate, my home loan rate will come down. The speed and efficiency at which this happens is called monetary policy transmission. So economic survey says that in the year 2022, the public sector banks were showing good monetary policy transmission compared to private banks, which means whenever Reserve Bank of India used to change the repo rate, it used to be reflected in the lending rate of public sector banks faster than the private banks. So now let us develop a basic understanding of monetary aggregates. Now guys, imagine that we are looking at the cash held by all the people in India, both the households as well as the business community. So a person like me as well as the business community. So let us say that they are holding this 100 rupees. People are holding this money as well as business community is holding this money. Now let us also look at the money that banks have deposited with RBI. And we have seen that banks also deposit their cash with RBI. So when they do that, they get a rate of interest these days called as a standing deposit facility. And banks also deposit CRR with RBI. So when you add currency in circulation, which means the currency which is with public as well as the currency which is with business community, when you add them, as well as the bankers deposit with RBI. So whatever banks deposit with RBI. So for example, let's say that this is the currency with public and this is the currency that bank has deposited with RBI. When you add both of them, it is called as M0 or M0. It is also called as reserve money. Now guys, imagine that this is the 100 rupees which is with public in India. So all the people of India are holding cash. Take that cash. Now imagine that we are also looking at all the savings account that people have in the banks. So people deposit their money in the savings account. So add both of them. So take the money that is there in the hand of the public currently. In that, add the money that people have deposited in their savings account, both of them. That is called as M1. M1 is called as narrow money. Now, when you talk about a public, there are 3 things. There is a small part of cash that people hold for their day-to-day expenses. Then people deposit their cash in the savings account. And people also go for fixed deposits in the bank. So 3 things: cash in the hand of the public, money in the savings account of the public, plus fixed deposit. When you add all the 3, that is called as M3. M3 is called as aggregate monetary resource. This is called broad money. M1 is called narrow money because here we take only 2 things: cash in the hand of public plus the money in the savings account. But in M3, we take cash in the hand of public plus money in the saving account, plus we also take the fixed deposits, for example. That is called M3. Now, there is a concept of money multiplier. What is money multiplier? Money multiplier is a ratio of M3 by M0, which means we take broad money by reserve money. What is the meaning of money multiplier? I'll give you an example. So money multiplier basically shows that Suppose somebody makes a deposit in the bank. So guys, suppose we are public and we are depositing 100 rupees in the bank. A small part of that 100 rupees is also sent to RBI for the maintenance of CRR, etc. And rest of the money by the bank is used to give as loan to people. So whenever we make deposit in the bank, a small part goes to RBI and rest of the money goes in the economy, which is given as loan to public. So money multiplier measures the extent to which a small deposit in a bank leads to overall increase in the money supply in the economy. That is the intuitive meaning of money multiplier. Now let us see what economic survey has to say this year. So economic survey has given this table where economic survey says that let us look at reserve money M0. And we just discussed that reserve money is equal to currency in circulation with public and business community plus the deposits that bank do with RBI. So if we compare the year 2021-22 with 22-23, we see that reserve money has come down. But even though it has come down, it is in double digit. So since it has come down, let us see which component has come down. So currency in circulation came down from 9.8 to 8.2% and bankers deposit also came down. But since this bankers deposit with RBI is in the double digit, it has led to overall stability in reserve money. That is what economic survey says. That whatever is the double digit figure for reserve money, it is mostly because of bankers deposit. Now let us look at narrow money. Narrow money is 10.7% earlier, now it is 7.6%. These are all called as money supply, different measures of money supply in the economy. Now let us look at broad money. We saw guys that in the broad money, we take currency with public and then we take the money that people have deposited in savings account and the money in the fixed deposits. So you see, broad money from 8.8%, it is 8.7%, which means more or less stable. Yes, it has come down a little bit, but more or less stable. So why has it come little down? So if we see, we find that currency with public has come down. See, currency with public is down and demand deposits have drastically come down. Right, which means money in the savings account has come down, but fixed deposits have increased. So see, from 8.1% to 9.1%, which means the very fact that broad money is more or less stable is mostly because of time deposits like fixed deposits. That has kept our broad money at that level. And economic survey says that whatever money multiplier is happening in the economy, so it is mostly happening because of broad money. Now we all know that when repo rate increased in the economy, fixed deposits rate increased and people started to deposit more money in the bank through fixed deposits. Now guys, let us look at the developments in the field of government securities market. Government securities are also called as government bonds. So basically, whenever Government of India has to borrow money, Government of India sells government bonds with the help of RBI. And economic survey says that who is the largest buyer of the government bonds? Public sector banks or private sector banks? Private sector banks. So we very often read in the newspaper and news that the yield on the government bond has increased. And newspaper says that when the yield of the government bond is increasing, that means the cost of borrowing money for the government has increased. And that's not a great news. And then the newspaper also says after a few months that now the yield is cooling off. What does it all mean for the economy and what does the economic survey say about that? So here I have taken some content from the newspaper and some from economic survey to give you the bigger picture of what is happening. So guys, let us see what is happening in the economy. Now imagine that this rectangle that you see, so suppose that this is a government bond or government security. What is the face value of the bond? Suppose 1000 rupee, which means if you want to buy this bond, you have to give, for example, 1000 rupees. If you give 1000 rupees to the government of India, for example, for 1 year, the government of India will give you 10% rate of interest. So which means that if you give 1000 rupees to government of India will return your 1000 plus 100, 1100 rupees after 1 year. This is called as government security or government bond. Now, there is a concept called as bond yield. What is the meaning of bond yield? See guys, bond yield is equal to the coupon rate, means rate of interest that the bond is providing, upon bond price. So here the coupon rate is 10% and face value is 1000. So what is the interest income that we will get through the bond? 10% of 1000, which means 100. So we will write 100 in the numerator. And what is the face value? 1000. So suppose we are buying the bond at face value only. Whatever is written on the bond, we are paying that. So 1000. So what is the bond yield? 100 upon 1000 into 100? 10%. 10% is the yield. Yield means the returns that we are getting because of our investment. So that is 10%. Let us look at intuitive meaning of bond yield through another example. Now guys, suppose that you buy a house, this is your house, and you have bought it for 50 lakh rupees. The moment you buy this house, suppose you put it on rent. And what is the rent money that you are getting? 20,000 rupees per month. So you invested 50 lakh rupees in a house and you are getting 20,000 rupees a month as rent. Now suppose that there is a news that the place where your house has been constructed, there is a new airport coming in the vicinity after a few years. The moment this news spreads, the airport has not come, but there is a news that airport will be constructed by the government of India. Now, if you go in the market to sell that house, you will get a higher price, 60 lakh rupees. So you decide to sell this out for 60 lakh rupees. And mind you, when you bought the house for 50 lakhs, you put it up for rent. So those people are still staying in your house. Airport has not come, but it will come after 5 years, which means the current rent that you will get is 20,000 only. So suppose you sell your house to somebody else. That person pays you 60 lakh rupees. And those people who are putting up on rent, they are still there on the rent and they are paying 20,000 rupees a month. So you had invested 50 lakhs and you are getting 20,000 rupees a month. Now that person who bought the house from you has invested 60 lakhs and that person is getting 20,000 rupees a month as rent. Which means what has happened to the yield? Yield has come down. Because earlier 50 lakh house was giving 20,000 rupees rent. Now 60 lakh house is giving 20,000 rupees on rent. Which means that yield has come down. So what did we see? That the connection between or the relationship between yield and price. So for example, the connection between or relationship between yield and price is inverse. So whenever the price goes up, the yield goes down. Let's do the reverse case. Now suppose guys that the pollution in the area, people are saying that the pollution in the area is increasing and after 10 years, it will be difficult to stay in the area where your house is situated. So you decide to sell the house, but the price that you will get is 30 lakh rupees only. But when you sell your house to somebody who bought it for 30 lakh rupees, those people who are on rent are still paying 20,000 rupees rent. Because in the short term, nothing is happening, but there is a rumor that this area will also be very polluted. So you just sold the house. So the person who bought the house for 30 lakhs from you, now they are getting 20,000 rupees rent, which means yield has increased. So whenever the price goes down, the yield goes up. Same thing is with the bonds. Let us see the story of the bond and what has happened. So what happened is, we see that there is inverse relationship between bond yield and bond price. So whenever bond price will go down, yield will go up. So you know what happened in the world is, there was huge inflation in the economy. So all the countries of the world, the developed countries, the developing countries, they started to increase the interest rate. USA was the leader. USA increased the interest rate a lot in a very short span of time. So when it started to increase the interest rate, now those people who had invested money in Indian bonds, they started to leave India and they started to say that why to invest money in Indian bonds? Because the rate of interest in USA is higher. So they started to go to USA, which means what happened to the demand of Indian bonds? It started to come down. So when the demand for government bonds came down, what happened to the bond price? When the demand of something goes down, what happens to its price? Its price also starts to come down. So our bond price started to come down. And we know, for example, let's say that 1000 rupee bond became 800 rupee bond. So when bond price comes down, what happens to bond yield? Bond yield goes up. So let us calculate the bond yield. 100 upon 800 into 100, 12.5%. So bond yield increased. And we know that when bond yield increases, so what will happen? The expectation in the society will be that since now bond yield has increased and the formula of bond yield is coupon rate upon bond price. So now there will be expectation in the economy that whenever fresh bonds are issued in the economy, the rate of interest will be higher. Which means now government is under pressure that if the government introduces new bonds in the economy, the government will have to increase the coupon rate. So cost of borrowing for the government also increased. And it is reflected in the economic survey in this graph. And the survey said that see how the bond yield increased in India. And later on it started to become normal, but it increased a lot. Guys, before we look at the developments of the banking sector as per economic survey, let us look at some of the basic concepts that we very often find in the news related to the banking industry. So I have created a small story for you which will help us to understand the basic concepts of banking. So let us take the example of State Bank of India. You see there are so many people in the SBI. Some people have come here to deposit cash. Some people have come here to take loans. So now suppose that in SBI, State Bank of India, around 1500 rupees has been deposited by the depositors. So see, this 1500 enters SBI. SBI is not going to give this entire 1500. So let us say that this is 1500, this comes to SBI. SBI is not going to give this entire 1500 as loan. SBI will keep, for example, 500 in its own pocket, and rest of the 1000 SBI gives as loan. So whenever a bank gives loan to public, bank will earn interest rate. So that loan is called the asset of the bank, property of the bank. So bank has given a total loan of 1000 rupees. Who gets loan? Public number 1, 2, 3, 4, 5. So suppose public number 1 gets 200 rupees. Now second one 300, 400, 200. And suppose this guy gets 100 rupees loan from the bank. He makes a promise to the bank that he's going to return the money along with rate of interest. But for 90 days, he's unable to return the money, which means principal 100 rupees or the interest rate. So now this bank, State Bank of India, they will call this guy and ask that, are you in a position to return the bank? He says no. So he says, I'm not in a position to return the money of the bank, neither principal nor interest. So the 100 rupees which he took, this guy took 100 rupees, that 100 rupees is called as non-performing asset of the bank. So out of 1000 rupee loan, see, out of 1000 rupee loan, this 100 rupees becomes the non-performing asset. So let us take this ratio. 100 is the non-performing asset, 1000 rupees is the total loan. So out of 1000, the non-performing asset is 100 rupees. So 100 upon 1000 into 100, 10%. So this 10% is called as gross non-performing asset ratio, GNPA ratio. And every bank in India tries to keep its GNPA ratio as low as possible. Has the GNPA ratio of Indian banking improved, which means has it come down in the year 2022 respect to 2021? Yes, it has come down. Now, so for example, in our story, let's continue the story. In our story, 100 rupees is the NPA, which means this bank, SBI, is not expecting 100 rupees to be back anytime now. Immediately, Reserve Bank of India calls SBI and says, State Bank of India, you have 500 rupees in your bank. Because depositors had deposited 1500, you gave 1000 rupees as loan, but you still have 500. From that 500, take out 70%, for example, 70% of the NPA. NPA means non-performing assets, the money which is not coming back easily. So 100 rupees is the money which is not coming back. So what is 70% of 100? 70 rupees. That is called as provisioning coverage. Right, so provisioning coverage ratio, or the amount is called provisioning coverage amount. So State Bank of India keeps 70 rupees in a piggy bank separately. And State Bank of India keeps the 70 rupees with itself. It doesn't give it to RBI, it keeps it with itself. So every time, this is an example, this ratio can change in real economy. So if SBI is able to keep 70 rupees as provisioning amount, so if somebody will ask State Bank of India, right, SBI, if this guy never returns your 100 rupees, because this 100 rupees was deposited by somebody, and then you gave it as loan. So if that person comes, depositor comes, will you be in a position to return their money? SBI says, yeah, I have 70 rupees provisioning amount. So if the depositor comes to me, I will return from this 70 rupees. So guys, there is a concept of net NPA. This is gross NPA, which we saw. Gross NPA is equal to total NPA upon total loan. But there is a concept of net NPA. Net NPA means from the gross NPA, which is 100 rupees, remove the provisioning amount. So 100 minus 70. Because 70 rupees is with the bank. So what is the shortage? 30 rupees. So 100 minus 70 is 30, which means 30 rupees is the net problem. So 30 upon 1000 into 100, 3%. This is called as net NPA. So our banking industry is trying to keep both gross NPA low and net NPA also low. Our net NPA has become very close to 1% these days, which is very, very good. And our gross NPA is very close to around 5 to 6% range, which is also very good because earlier it was more than 7.5%. Now let us look at the concept of return on assets. So guys, suppose you are a factory owner. In your factory, you bought a new machine. So whenever you buy a new machine, that is called asset. What is expected from you? That whenever you buy a new machine, it will lead to increase in income of your factory. So whenever you buy a new asset, people want to see how much is the increase in income. That is called as return on asset. Similarly, for a banking industry, whenever a bank gives loan, that loan is the asset of the bank, then bank starts to get interest income, which is the income. So whenever the bank creates more assets, people want to see how much is the increase in income of the bank. That is called return on asset. So is the return on asset of the Indian banking increasing these days? Yes, it has increased in 2022 compared to 2021. Now there is one more concept called as capital adequacy ratio or capital to risk weighted asset ratio, CRAR. So guys, suppose that we start a company or we start a bank. Bank is also a company. So suppose that you and I together start a bank or a company. So what are we going to do? We are the owners. So we will take some cash like this and we put the cash in the account of the company and we will become the owners. Now, in future, if somebody comes to the bank and says that they want to take loan, so we will give loan to that person. So Reserve Bank of India asks a question that what is the ratio of the total capital that the bank has compared to the risky loans that the bank has given? Because if the bank keeps on giving risky loans and tomorrow the loan never comes back, it becomes non-performing asset. So how will the bank repay the money of the depositors? So Reserve Bank of India asks a question that whenever banks are giving risky loans, no problem. But is the bank having enough capital in its pocket so that if the risky loan doesn't come back or something goes wrong, the bank is able to survive? That ratio is called as capital adequacy ratio. In India, this ratio is currently in a very healthy state. So for example, Basel, according to Basel norms, this ratio should be close to 8%, but in India, we are well above 8%. So mostly in India, it is between 8 to 12% range, which is very healthy. And this capital adequacy ratio formula that you see, capital by risk weighted asset, this capital is of two types, tier 1 and tier 2 capital. So this is in a healthy state. So guys, let us look at the scheduled commercial banks like HDFC, SBI, etc. So what is their gross NPA currently? So their gross NPA is around 5% in India. And let us see if the gross NPA of our scheduled commercial bank has come down. So scheduled commercial banks give loan to agriculture sector, industry, services. They also give personal loans. So we see that the NPA problem is coming down in agriculture, industry, services and personal loan, all the segments, which means whatever money different sectors are taking from our banks, they are returning that money. So NPA problem is coming down, which is a very, very good thing for the economy. Let us look at scheduled commercial banks and how they have been giving loan to different sectors in the economy. So see, the loans given by scheduled commercial banks is increasing. Because of COVID, it was coming down, but now it has been increasing. And let us look at the growth of credit or loan by scheduled commercial banks. See, our scheduled commercial banks like SDFC and SBI, they are giving loan to agriculture sector. It has increased. Industrial loan increased, service loan increased, and personal loan has also increased. Let's look at NBFCs. So what is the ratio? GNP ratio. So gross non-performing asset ratio of NBFCs, it's around 5.9%. So our NBFCs, non-banking financial companies, they are also giving loan to agriculture, industry, service, personal loan, others, etc. So is the NPA coming down? So whenever they give money to agriculture sector, is it leading to more NPA or less NPA? So we can see that the level of NPA in the agriculture sector has come down, level of NPA in services have come down, personal loan have come down, others have come down, right? In the industrial sector, the level of NPA has come down, but the reduction or decrease in the NPA is not very significant as compared to services, for example, or agriculture. So yes, it is coming down. The NPA in industry is coming down, but the reduction is not that great. But yes, it is good because there is reduction in NPA, but we can do better there. Now, let us look at the money given by NBFC, non-banking financial companies, as loan. So are they giving more money as loan? So you see, to agriculture sector they are, to services they are, personal loan yes, others yes, to industry they are giving loan, but the way they are giving loan is not very encouraging, which means NBFCs have become a little cautious when they are giving loan to industries. And we see the reason why, because we can clearly see that the NPA problem of industries is yes coming down, but it is not coming down in a very significant manner. That is why NBFCs have become a little cautious. Now let us look at some of the developments related to insolvency and bankruptcy code. And by the way, we have discussed the details of how insolvency and bankruptcy code is implemented in India in lecture number 2 of the economics survey series this year. So you can watch that video if you want the details of insolvency and bankruptcy code. But let us look at some of the latest developments that is given in this topic of the survey. You see, let me tell you a small story. So suppose that there is a company. Now the value of this company currently, value as in the value of total assets and properties of this company is 100 crore rupees. Now this company has taken loan from a bank, and guys, you very well understand that when you take loan from a bank, you have to give something as collateral or security. Now so for example, a bank or a financial institution which provides you cash or capital is called as financial creditor. And they expect that you will return their money also. Similarly, suppose this company has taken services of some people or bought raw material from some people. So when somebody gives you service or somebody sells you raw material for your company, they are called as operational creditor because you have to make payments to them in future as well. Which means that if you are taking services and goods from somebody, in future you are supposed to return their payment. So they are operational creditor. And what is this company? This company is called as corporate debtor, which means they are in debt, they have taken loan. So there are 3 things that we have seen. First is financial creditor. Second is operational creditor. So these are the people who expect some payment from the company. And company is the debtor because company has taken loan. Now suppose guys, this company says that I am not in a position to return the money. So this is a situation where, for example, the financial creditor would come to the company and say that, you were supposed to return the money. If you don't, then financial creditor, operational creditor, they will come together and they will say that we are going to sell your company. Now, what are the different ways in which the financial and operational creditor can recover the money? So for example, they can go to lok adalats, where the financial creditor, operational creditor and the corporate debtor, all 3 will sit together and they will decide outside the court about how to do the settlement. So lok adalat. Or for example, there is an act called as Sarfazi Act. Under Sarfazi Act, for example, this financial creditor, they have got some collateral of the company, which means some properties, etc. They will sell it to recover the money. That is also one of the way. Another way could be debt recovery tribunals. So for example, these creditors will go to a debt recovery tribunal, a company. That company will take control of this debtor and it will sell this debtor's assets, recover the cash and return the cash to them. That is also a method. And the latest method started by Government of India is called as Insolvency and Bankruptcy Code. What is Insolvency and Bankruptcy Code? Under that, either financial creditor or operational creditor or debtor, either of these three, they can go to Insolvency and Bankruptcy Code and they can say that we want to solve this problem. And these days it has been observed that these corporate debtors also go to the government and say that let us solve the problem, because they know that if they don't go to the government, their company will be sold and they will get nothing. So under Insolvency and Bankruptcy Code, any of these three entities can begin the proceedings to solve the crisis. And the first target of Insolvency and Bankruptcy Code is not to sell the company who is under problem, the company which is under the problem. But the first reaction of Insolvency and Bankruptcy Code is to resolve the issue and not to sell this company. But if issue cannot be resolved, then only they sell the company. If they go and sell the company in the market, now suppose the price, I told you that the original price of the assets and properties of the company is 100 crore. But this company is making losses. It is not in good health. And if you go and sell this company in the market, the buyer will not pay you 100 crore. The buyer will pay you less amount. They will ask for discount. So suppose the buyer is ready to pay 90 crore, which means the original price 100 crore, buyer is paying 90 crore. So what is the discount that the buyer is asking for? 10 crore. So this 10 crore discount is called haircut. Right. So Insolvency and Bankruptcy Code tries that this haircut should not be very big, which means if 100 crore company is being sold, they try to maximize the amount 90, 95, something like that. So the economic survey says that in the year 2022, approximately 5,893 cases related to insolvency and bankruptcy, they were forwarded to the government. Out of that, 1,947 cases are ongoing and 3,946 cases have been closed. Out of these closed cases, so roughly around 14% of the cases, they were resolved, which means the company was not sold. They saved the company. 48% of the cases, the company was sold, and here the haircut was very small, which means it's a good thing. And roughly 38% of the cases, it was sent for review or the cases were withdrawn. That was also solved. So it's a good progress they are saying. Now, if you look at different methods of recovery of money, so suppose I am a bank, I have given my money to somebody is not returning the money. I have so many options to recover it: insolvency and bankruptcy, SARFAESI, debt recovery tribunal and lok adalats. But which is the most popular method these days in 2022? So the best method which was used, which gave more results, was Insolvency and Bankruptcy Code, followed by SARFAESI, then Debt Recovery Tribunal and Lok Adalat. So most of the insolvencies in India, they happened through IBC in 2022. This is the sequence. Now guys, before we look at the latest development related to capital market, let us look at the story and the basic concept of the capital market in India. Now guys, imagine that we take a company, Tata's. Tatas want to sell their new shares and bonds. When a company sells new shares, we call it equity. And when a company sells new bonds, we call it debt. So suppose Tatas want to sell their new shares and bonds. In which market will they sell their new shares and bonds? In the market called as primary market. Now, suppose they sell the share and bond to you. Right? In the story, you are the buyer. So where did you buy it? Primary market. So capital market has one segment called as primary market where new shares and bonds are sold. Now suppose you want to sell the shares or bonds of Tata's to your friend. So now when you sell the shares and bonds, they are not new shares and bonds. They are already used. So you will sell the shares and bonds to your friend in a market which is called secondary market. So that secondary market, for example, has a name that is called as National Stock Exchange, Bombay Stock Exchange. So when you sell the share, it is secondary market. So capital market is divided into two segments, primary and secondary. This is primary, this is secondary. Now, sometimes if you want to know that what is the performance of the secondary market. How do you know the performance of the secondary market? The secondary market is said to perform better if investors like your friend, they are ready to pay good price for the shares and bonds that are being sold here. And which are the companies whose shares and bonds are being sold here? So some of the best companies of India, Infosys, Tata, etc., their shares and bonds are available here. And if the investors are ready to pay good price for them, then we will say that the stock market is performing well. The secondary market is called stock market. How do you measure the socio-economic development of a country, guys? To measure the socio-economic development of a country, we use an index called as Human Development Index. And how do you measure the performance of a student in the exam? Through CGPA. Similarly, if we want to find out what is the performance of stock market, we use an index called as Stock Market Index. I'll give you an example. So for example, the top companies of India, their shares are being sold here, their bonds are being sold here. We want to find out what is the performance of National Stock Exchange and Bombay Stock Exchange, the secondary market. So what we will do is, we will take, for example, top 50 companies of India, and we will see what is the price of their shares in the National Stock Exchange, top 50 companies. If the prices are high, we will say that NSE Nifty 50 is high. So NSE Nifty 50 measures the performance of top 50 companies in the National Stock Exchange. Similarly, if we go to Bombay Stock Exchange and we take top 30 companies there and try to find what is the performance of the top 30 companies in terms of their equity price. So if the performance of the top 30 companies is good, we will say BSE Sensex 30's value is increasing. These are called as stock market index. And what did we do to find out stock market index? We looked at top 50 companies, top 30 companies, and we found out what is the equity price of these companies. Are people ready to pay high price for their shares or not? So guys, suppose today the NSE Nifty 50 is showing a good performance, it's very high, which means people are ready to pay high price for the shares. Tomorrow it becomes very low. Day after tomorrow, high, low, which means there is huge fluctuation in NSE Nifty 50. So whenever there is huge fluctuation in NSE Nifty 50, that means are people very positive in the market? No, they are not very sure. They are confused. There is a sense of negativity. How do you measure this up down value or volatility? To measure the volatility in NSE Nifty 50 or BSE Sensex 30, we use another formula or index called as India VIX. So India VIX is a formula or a method which measures, or it's an index which will measure the volatility in NSE Nifty 50 or BSE Sensex 30. So whenever the value of India VIX is very high, that means NSE Nifty 50 and BSE Sensex are very volatile. That means people are feeling sense of negativity in the share market. That is why sometimes the price of shares are going up, going down, which means there is inverse relationship between India VIX and NSE Nifty 50. When India VIX is high, NSE Nifty 50 is low. That means people are not very happy in the market because we don't want high volatility. But when the volatility is low, that means people are very happy. So NSE Nifty 50 will be very high. So let us see what actually happened in India. In the primary market between April to November 2022, in the equity market, which means the market where new shares are sold, the companies sold the shares, but the resources that the company raised by selling share, and what do companies get by selling share? Capital. So that capital was not very high. Compared to 2021, the capital raised in the primary market was little low through equities. In the debt market, where the companies sell bonds, they raised more money in 2022 compared to 2021. If you look at the secondary market of India, we can see about the India VIX. By the way, India VIX is also called as fear index. Whenever the value of India VIX goes up, that means people are scared and there is a sense of fear in the market. So between February to March 2022, this is the time when we saw that there was this Russia-Ukraine tussle. So there was increase in India VIX value, or fear index increased in India, and there was pessimism. Everybody was confused. But over a period of time, the fear has come down. And we see that the value of India VIX has come down. And we know that when the value of India VIX comes down, the value of NSE and BSE goes up. So let us see, economic survey has given a comparison. We don't need to look at the entire data. We just need to look at some parts of it. So for example, this is for India, NSE Nifty 50 and BSE Sensex. This is for the year 2022-23. compared to previous year, there has been growth. See, positive. So both NSE Nifty 50 and BSE has increased, which means our stock market has shown good performance. But look at other countries like China, Brazil and Korea. Their performance is negative, which means their stock market shows a lot of volatility and negativity. Look at the developed countries of the world like USA, Germany, UK, etc. You see negative points, which means they also registered negative growth, which means economic survey is saying that Indian stock market, Bombay Stock Exchange and National Stock Exchange, they were very resilient and strong. Not in absolute terms, but compared to others, we did better. So now let us look at the scenario of investment in India. So guys, who makes investment in India? Two kinds of entities. One is domestic institutional investors, for example, LIC, for example, SDFC Bank. So banks, insurance companies and other financial institutions which are Indian companies and they make investment within India, they are called as domestic institutional investments. Now similarly, when a foreign investor comes to India and they make investment in India to get huge profits, they are called as foreign portfolio investors. These foreign portfolio investors are here in India only to get profit. They are not interested in ownership of Indian companies because they come to India looking at the interest rate in India, which is high compared to other countries. So they come to India to take advantage. But whenever the interest rate in countries like USA increases compared to India, they leave India and go to that country. So what is domestic institutional investors? Insurance companies, banks and other financial institutions like mutual funds which are Indian and they make investment in India. They are DII and foreigners are FPI. So let us look at their behavior in India, the behavior of DII and FPI. So you know what happened in India. So what happened is that to control inflation, countries like USA increased the interest rate. When they increased interest rate in USA, so from countries like India and China. India and China basically are those countries which import a lot of commodities. So what happened is money from these countries at the time when interest rate was increasing, some money returned back to USA dollars and some money from India and China, which are the countries which import a lot of commodities. Some money from these countries went to countries like South Korea, Indonesia and Brazil, which were trying to export a lot of commodities. So we observed a typical pattern in 2022 that when rate of interest was increasing in USA, so from countries like India, China, etc., some dollars went to USA. And other dollar from India, the foreign portfolio investment, from India and China, the dollar also went to countries like South Korea, Indonesia and Brazil because these are those countries which are putting more efforts in the production and export of commodities, which means dollar has been moving away from importing countries to exporting countries. This is written in the economic survey. This statement can be asked in UPSC. So that is one. And second, when the foreign portfolio investment was leaving India, so we felt a problem of investment. So when FPI was leaving India, who was trying to give us a cushion or support? So domestic institutional investors were trying to compensate India for the loss of dollars because of FPI. So FPI was going away from India, and to compensate for that, the domestic institutional investors like insurance companies, mutual fund and bank, they were investing more money within India. So our own investors tried to help the Indian economy. That is also written in the survey. So please see, this is the graph which I have created related to foreign portfolio investment. This graph is directly not given in the survey. They have given some data. So I just converted it into this graph. So this is a graph for the year 2022. See, so total 16,153 crore went away from India through FPI. So FPI came down between April and July. In August it increased, then again came down, and November it increased, and again it is coming little down. So the trend has been zigzag, but the money went away from both equity and debt market, which means the foreigners who had come to India, who bought bonds, they sold the bonds. Those who bought the shares, they sold the shares. And roughly 16,000 crore foreign portfolio investment from India left. And we already saw this. through economic survey that money from countries like China, see, negative means money went away from China, India and South Africa. And where did money go? Money go to countries like Korea, Brazil, Thailand, right? These are the countries where money went. So money went away from countries who are importing commodities to countries which are exporting commodities. And let us look at the domestic investor. See, this is what I was talking about. So every time, guys, this graph, see, this graph shows that foreign portfolio investment is coming down. So every time our FPI was coming down, our domestic investment was trying to compensate. See, FPI coming down, domestic investment trying to compensate. That is why economic survey says domestic institutional investment acted as countervailing force to FPI outflow. So guys, if you go to Singapore, you will find something very interesting. Now, if you want to buy the shares or bonds of any big company of the world, you can find it in Singapore financial market. Similarly, suppose if you are the owner of a company and if you want to sell shares or bonds, you can easily sell it in Singapore financial market. You can access any bank of the world. All major banks, financial institutions are present there. Why? Because Singapore is actually International Financial Service Center. India also wanted to develop a similar kind of International Financial Service Center. And this concept actually started to take shape in India in the discussion mode around the year 2008 itself. And finally, we have International Financial Service Center, IFSC, Gujarat International Finance Tech City, Gift City, as it is popularly called as, in Gandhinagar. So what is the concept of International Financial Service Center? Let me tell you what is this concept and why India needed that. Now, for example, we very well know that if we want to convert rupee into dollar, dollar into rupee, for normal purposes, we can. If you are going for tourism outside India, if you are going for higher studies, you can. But for all purposes like business purposes, etc., if a foreigner comes to India with dollars and says, convert my all dollars into rupee, if Indian says, convert all my rupee into dollar, for all purposes, that is not happening. Which means capital account convertibility is limited in India for obvious reasons, because we don't want to give too much exposure to our economy in terms of currencies, etc. Similarly, if a foreign company wants to sell their equity shares or bonds directly in India, we don't allow them as such. So there are too many restrictions and we are little careful in our financial market. But Government of India realized that since this is globalized world, we also want such a place or system whereby if a foreign company wants to sell its products like shares, bonds, etc., or somebody wants to start a banking service or mutual fund company in India from a foreign country, so we can allow them to do that. Similarly, if Indian companies want to sell their shares, bonds, etc., or mutual fund products to foreigners, so we should have a system to help them. So to do that, the Government of India has created International Financial Service Center in Gandhinagar, which looks like this. So there are two kinds of facilities that we have created here. First, we have created normal infrastructure like schools, hospitals, recreation area and residential area as well. So this is the regular infrastructure we have created. But the main infrastructure that we have created in the International Financial Service Center is we are allowing banking, insurance, mutual fund, and finance related companies, and we have also established one international stock exchange here where all the shares and bonds of foreign companies and Indian companies can be bought and sold in that market. Now we know that if there is a bank in India, normally it is regulated by RBI. Similarly, we know that capital market is regulated by SCB, Securities and Exchange Board of India. Insurance sector in India is regulated by IRDAI, Insurance Regulatory and Development Authority of India. Similarly, pension sector is regulated by PFRDA, Pension Funds Regulatory and Development Authority. So since we are going to allow all these functions in IFSC, Gift City, so we needed to create a separate regulator which can regulate all the kind of activities within IFSC. So the Government of India created International Financial Service Center Authority, IFSCA. This is that regulator which is going to regulate the activities related to banking or capital market or insurance or pensions, etc. within IFSC, which means this regulator is going to perform all the functions that is performed as a regulator by these four regulators: RBI, SCB, IRDA and PFRDA, but only inside IFSC. Only inside this IFSC, IFSC-A will be the regulator. So if somebody will ask us a question that what do you mean by IFSC, International Financial Services Center? So we can say that IFSC has two kinds of facilities. One, it has high concentration of financial institutions, which caters to both residents and non-residents. And second, infrastructure like school, hospital, etc., etc. And then we can say that there is a unified regulator as well, like IFSC-A, which has assumed the power of four domestic regulators, these four. And we can see that we also have one international stock exchange called as India INX. And we can see that IFSC has signed memorandum of understandings, and we have signed different kind of cooperation agreements with, for example, Singapore, Dubai, Qatar, Abu Dhabi, with so many different countries. We also know that inside IFSC, Gift City, Gujarat, there is a regional office of New Development Bank, which is also there, which means that it is putting India's financial market on the global map. And that was exactly the purpose. Now let us understand what is the meaning of insurance sector and what are the different schemes by Government of India to promote insurance sector in India. Who regulates the insurance sector? Insurance Regulatory and Development Authority of India, IRDAI, they regulate the insurance sector. What is an insurance? A basic example. So guys, suppose that you buy a car. The price of the car is, let's say, 10 lakh rupees. Now, when you buy the car, you have to pay a small amount called as insurance premium. So for example, let's say you pay 60,000 rupees as insurance premium. The moment you do that, now your car has been insured. So if there is any accident, there is any damage, etc., your car is not working, so then the company to whom you have paid the premium, they will provide you the compensation to help you fix your car, etc. Similarly, we have health insurance, we have home insurance, and we have different type of insurances. So what is the role of an insurance? So there are two roles of insurance basically. The first is protection, because as I told you using the example that if there is any damage or accident, etc., God forbid, then if you have opted for insurance, you will get compensation. Similarly, guys, when we pay the premium to the company, insurance companies, those companies take our premium and they invest that money in different places in the economy. So for example, in one of the lectures, we have already discussed something called as National Infrastructure Pipeline, under which we have seen how Government of India is investing 111 lakh crores for the development of infrastructure in India. So these insurance companies also collect premium from us and they invest the money in different infrastructure projects in India and they make profits. So insurance provides two roles in the economy. First is protection and second is it increases savings in the economy. That saving is invested and it might lead to development of infrastructure. But how do we measure if the level of insurance is good in an economy or not? So for example, if you look at the top countries of the world, which are the most insured country, so you can see that USA has the best insurance market, followed by China and Japan. India's rank in terms of premium collected is ranked 10th in the world. How do we know if India's insurance sector is doing well or not? Two formulas are used for that. The first is called insurance penetration. How do you find it? So take the total premium paid by the people who have taken insurance and divide it by the GDP of India. That is called insurance penetration. So it's 4.2% currently, which is an improvement. It is good. Now, similarly, there is another formula called as insurance density. So it is total premium divided by population. It shows how insurance has reached different people in the economy, which means per head insurance. So that is $91 currently. That has also showed improvement. Let us look at some of the schemes related to insurance in India. The first scheme that we are going to do is Ayushman Bharat scheme. This question was asked in UPSC prelims last year. Now, Ayushman Bharat has two components. First is preventive component. Second is protective component. Under preventive component, the Government of India has set a target to establish 1.5 lakh health and wellness centers to promote primary healthcare facilities. But God forbid, suppose somebody requires surgery, which means secondary and tertiary healthcare. Then the government of India provides a health cover or health insurance of rupees 5 lakh per family per year, so that the person can go for hospitalization, etc., related to secondary and tertiary healthcare facilities. Now, can you go for hospitalization only in the government hospital? No, both under government and private hospital, you can go and avail the facilities. Under this Ayushman Bharat scheme, the government of India plans to cover around 10 crore poor and vulnerable section of the society. Then there is another scheme called as PM Jeevan Jyoti Bima Yojana. Now, this scheme is related to eventualities like death. So in case of death, if you have opted for this insurance, you will get a cover of 2 lakh rupees, and eligibility for this scheme is 18 to 50 years of age. There is another insurance scheme called as PM Suraksha Bima Yojana. This scheme is related to accident. So if you suffer from an accident and if you have opted for the scheme, in case of accidental death or full disability because of accident, 2 lakh rupees is given by the government. But for partial disability because of accident, 1 lakh rupees cover is provided by the government. Another scheme is PM Fasal Bima Yojana. This is for farmers. So in case the farmers suffer a loss due to crop failure or poor monsoon or pest attack, etc., the government of India has created this insurance scheme which can compensate the farmers. For this, the farmers have to provide a very small premium. So for Kharif crop, premium of 2%, Rabi crop 1.5% premium, commercial and horticulture, which means fruits, vegetable, etc., 5% premium has to be provided. Now guys, let us look at the pension sector. Though economic survey topic number 4, it does not talk about the pension sector in great details, but we will look into it to have a wider coverage. You see, there was a huge debate recently which was there in the newspaper that some states of India are following the old pension scheme, some are following the national pension scheme, which is also called as new pension scheme. What is this debate and what is happening in India? Let us see. So guys, there was this old pension scheme in India, under which, suppose you are a government employee, suppose you become an IAS officer, government employee. Now suppose your basic pay or basic salary is 1 lakh rupees at the time of retirement. Now the government of India used to fix your pension using the following formula. So whatever was your last drawn salary during the retirement, 50% of that salary, which means 50% of 1 lakh rupees, 50,000, plus a dearness allowance. What is dearness allowance? So whenever inflation increases in the economy, the government of India increases the salary to compensate the people for rise in inflation. That is called dearness allowance. So for example, dearness allowance of 4%. So 50,000 plus whatever is the dearness allowance based on inflation, that will be given to you as your monthly pension. This entire pension was provided by the government of India. Another name for this old pension scheme is defined benefit scheme, because under this scheme the government of India already defined the formula, right? This is how you will get the benefit. In this case, the pension was not supposed to be taxed, and the government of India did not impose any tax on this pension that you are getting. This is also called as assured pension, because whatever was your salary, 50% of that is being given to you as your pension. But the government of India developed a new formula called as National Pension Scheme 2004. Now here the things changed a little bit. So for example, if your salary is 100 rupees, example. Now, and if you are a government employee, by the way, this pension scheme applies to both government and private sector, but let's take the example of government employee. So you are a government employee. If your salary is 100 rupees, 14% of your salary is contributed by government and 10% you have to contribute. So total 24%. This 24% every month will go in National Pension Scheme. Now, when you retire, 60% fund that has been accumulated will be given back to you, and Government of India will not impose any tax over that. But the rest 40% amount that is there, which is your money, that will be invested and you will get returns from that amount, that 40% amount. And when you get return from that amount, so for example, you are getting annual returns. When you are getting annual returns, you have to pay a tax on that as well. So this 40% is taxable, this 60% is not taxable. And who is regulating this national pension scheme? So Pension Fund Regulatory and Development Authority, they are regulating it. And one of the features of this scheme is that if you need emergency funds, so 3 years after the scheme has started, so you can withdraw 25% equivalent amount from here as emergency withdrawal and use the money. This is called as National Pension Scheme. Now there is one more pension scheme in India called as Atal Pension Yojana. So what is the coverage? All the individuals between 18 to 40 years of age are covered here. But what is the focus area of this scheme? Focus area is to cover the underprivileged, unorganized and low income individuals. Now, which state is doing the best in Atal Pension Yojana? Maharashtra. In Atal Pension Yojana, the coverage to male members is 56%, female 44%. So the ratio is very good. Male is to female ratio. But if you look at the National Pension Scheme, out of 100 people who are getting the benefit of the scheme, 74 are male, 26 is female, which means the gender ratio needs to improve. Guys, another scheme is PM Vyay Vandana Yojana, under which Life Insurance Corporation, LIC, provides pension to individuals above 60 years of age. It is an assured pension scheme under which LIC provides a certain amount as pension for 10-year time period. To avail this scheme, you have to pay a minimum subscription amount. So for example, it starts from 1.5 lakh rupees. So if you pay 1.5 lakh rupees, then LIC will provide you 1000 rupees per month as pension. If you pay 7.5 lakh rupees subscription amount, you will get 5000 rupees per month as pension. Guys, now let us look at some of the recent and contemporary developments in the field of money and finance. In the year 2018, the Reserve Bank of India had banned something called as cryptocurrencies. But Supreme Court of India lifted the ban. And last year, in the budget, the government of India had imposed a tax on cryptocurrencies and digital currencies. At that time only, the experts had said that maybe that was the first step before the government of India in future brings out a policy related to cryptocurrencies. Two things are mentioned in the economic survey. So for example, economic survey says that there is this exchange FTX which collapsed. And what used to happen in this exchange? Cryptocurrencies were traded in this exchange. When the exchange collapsed, economic survey says that there are two messages behind the collapse. First message is that the field of cryptocurrencies, it is very volatile and vulnerable in nature. That is why it collapsed. And number two, since it is prevalent across the world, and whenever things change in the world, it becomes globalized. So economic survey says, why not regularize them and accept them as one of the new tools in the field of finance and capital market and then regulate them. Then economic survey says that already discussions related to cryptocurrencies is happening in G20 and OECD. And economic survey also makes a point by saying that European Union, Japan, Switzerland, UK, Albania, Nigeria, they are also in some way, they are creating policies to legitimize, or they are in the process of doing that. So it's time that India also discusses that and India also thinks about it. This is what is written in the economic survey. So they have not given a clear-cut policy approach as to what they are going to do, but they have just begun the introduction and the discussion. So guys, let us also spend a few minutes to understand what is cryptocurrency. So guys, suppose you look at this currency and I ask you a question that who has issued and printed this currency? RBI, Reserve Bank of India. Which means there is a centralized authority and the system through which currencies are printed and circulated in the economy. We have today seen different measures of money supply. Whenever RBI prints this currency, it has intrinsic value because behind this currency, there is some asset with the RBI. On the basis of some asset only, RBI prints this currency. So in the economic survey, the government has argued that cryptocurrencies are virtual currencies. They are like digital currencies without any intrinsic value and also without any cash flow behind them. If you look at this normal currency, there is some intrinsic value. But if there is a virtual currency, there is no intrinsic value attached to it. So The economic survey says that first, there is no intrinsic value, and second, there is no central authority which issues it. So we don't know who is issuing it. Anybody can issue it. It's privately issued. It's decentralized. These are two big problems with cryptocurrencies, and economic survey says that unless we find a solution to that, we cannot regularize it. Now the question arises, how is the cryptocurrency printed? So it is cryptocurrency comes into existence through a process called as mining. And how does the cryptocurrency get transferred from one person to another? And how is it stored? Through blockchain technology. So there is very advanced level coding, digital coding. This is called as encryption. So whenever cryptocurrencies are transferred between two people, so it's highly encrypted, advanced level coding. Economic survey says that all this coding, mining is fine, blockchain technology is fine. But the next problem with cryptocurrency is that suppose I'm holding cryptocurrency, it doesn't give me a sense that I'm holding anything tangible because there is no asset behind it. Even if I transfer cryptocurrency from my wallet, digital wallet, to somebody else's wallet, I'm not transferring something tangible. It's as if I'm transferring some codes and I'm transferring some digital key to somebody else. So economic survey says that we need to give some value to it, legitimize it. Only then we can initiate a discussion related to cryptocurrencies. And with this, we conclude lecture number 9 of the economic survey series. See you with the final lecture very soon. Thank you so much.